I was refreshing dealer websites when the first sold out banner appeared, triggering a cascade that would destroy the retail silver market within hours. Wednesday, December 10th, 2025, 11:43 a.m. Eastern, the exact moment that marked the beginning of the end for retail silver availability in North America. What started as isolated inventory shortages at smaller coin shops quickly escalated into a systematic collapse of the entire precious metals distribution network that would leave millions of investors staring at empty virtual shelves while silver prices climbed to levels that should have triggered massive supply releases. The first domino fell at Monument Metals in South Carolina, a family-owned operation that had served the precious metals community reliably for over 15 years. Their homepage, which had displayed hundreds of silver products with in-stock notifications just hours earlier, suddenly showed a stark message in red text. Due to unprecedented demand and supply chain disruptions beyond our control, we are temporarily suspending all silver sales until inventory can be replenished from our suppliers. The timestamp on their notice read 11:43 a.m., but I knew from monitoring their inventory levels through automated tracking software that they had been operating with dangerously thin stock for weeks. Within minutes, my phone started buzzing with alerts from the comprehensive inventory monitoring system I had programmed to track major dealers across North America. The alerts came in rapid succession like dominoes falling in perfectly timed sequence. JM Bullion's American Silver Eagles disappeared from their website at 11:47 a.m., showing temporarily out of stock, where hundreds had been available an hour earlier. APMEX marked their monster boxes as temporarily unavailable at 11:51 a.m., their premium silver rounds following just minutes later. By noon Eastern Time, SD Bullion had suspended all silver coin sales, posting an urgent notice that they were experiencing unprecedented demand that has temporarily exhausted our available inventory and forced us to suspend sales until our supply chain can be restored. Golden State Mint followed at 12:07 p.m., then Provident Metals at 12:15 p.m. The largest precious metals dealers in America were falling like dominoes, each announcement triggering panic buying at the remaining dealers that accelerated their own inventory depletion. I realized I was witnessing something that precious metals markets had never experienced in the modern era. A complete breakdown of the retail distribution system while prices were rising rather than falling. In every previous supply shortage I had observed over 2 decades of precious metals investing, shortages occurred during price spikes that quickly reversed, allowing dealers to restock at lower wholesale costs. But this time was fundamentally different. Supply was disappearing while demand remained insatiable at any price. The mathematics of retail silver distribution had been deteriorating for months in ways that most investors hadn't recognized, because dealer websites continued displaying available inventory even as their actual stock levels approached critical thresholds. Most online dealers operated using a sophisticated but fragile just-in-time inventory model that allowed them to display products for sale before they physically possessed them, relying on their ability to source metal from wholesalers within 24 to 48 hours of receiving customer orders. This system worked flawlessly when silver moved predictably within established trading ranges, allowing dealers to hedge their inventory risk and maintain profit margins while offering competitive pricing to customers. They could take your order for 100 Silver Eagles on Monday, source them from their wholesaler on Tuesday, and ship them to you by Friday without ever holding significant inventory that tied up their working capital or exposed them to price volatility. But the system was designed for normal market conditions, where supply and demand remained in reasonable equilibrium, not for the industrial demand explosion that began overwhelming global silver supplies in late 2024. As semiconductor manufacturers, solar panel producers, and electric vehicle companies began consuming silver at unprecedented rates, the buffer of available inventory that sustained the dealer distribution network started evaporating faster than it could be replenished. I had been tracking the warning signs for weeks through relationships with wholesalers and distributors who operated between the major refineries and retail dealers. We're seeing lead times stretch from 48 hours to 2 weeks, then 4 weeks, now 6 to 8 weeks for standard products, explained Robert Chen, who managed procurement for a major precious metals distributor in Texas. The refineries are running flat out, but they can't keep up with demand from both industrial users and retail investors. The industrial buyers were creating a hidden drain on available supplies that retail investors couldn't see or anticipate through normal market observation. When Samsung needed 2 million ounces for their solid-state battery production lines, they didn't visit dealer websites or compete in retail markets. They called refineries directly and offered premiums of 15–20% above spot prices that guaranteed priority allocation and immediate delivery. Their procurement contracts bypassed the entire retail distribution network, removing massive quantities of silver from the supply pool before it ever reached dealers. When Tesla required silver paste for their gigafactory solar panel production, they approached the situation with the same strategic thinking that had revolutionized the automotive industry. Rather than purchasing silver through traditional commodity markets, they negotiated long-term supply agreements with mining companies, effectively financing mine expansion in exchange for guaranteed delivery of unrefined silver ore at fixed prices. This vertical integration strategy insulated them from spot price volatility while ensuring supply continuity for manufacturing operations that couldn't tolerate interruption. Apple's procurement team had been quietly accumulating silver inventory for 18 months, anticipating supply constraints that their supply chain analysis indicated were becoming inevitable. Their strategic stockpiling program involved purchasing silver through dozens of different suppliers to avoid creating observable market impact, but the cumulative effect was to remove tens of millions of ounces from available supplies while maintaining the appearance of normal demand patterns. First Solar's industrial consumption represented one of the largest and most consistent drains on global silver supplies, consuming approximately 200,000 ounces monthly for their photovoltaic panel manufacturing operations. Unlike financial investors who could delay purchases if prices seemed too high, First Solar's production schedules were locked in by utility contracts that imposed severe financial penalties for delivery delays. Their procurement team was authorized to pay whatever premiums were necessary to maintain uninterrupted silver supplies. Chinese electronics manufacturers were consuming silver at rates that dwarfed traditional investment demand, using the metal for everything from smartphone circuits to high-voltage power transmission equipment. Companies like BYD, Foxconn, and China Electronics Corporation were purchasing silver through state-controlled trading entities that operated with effectively unlimited budgets and timelines measured in decades rather than quarters. The automotive industry's transition to electric vehicles was creating an entirely new category of silver demand that hadn't existed 5 years earlier. Every Tesla Model S required approximately 75 grams of silver for battery management and electromagnetic shielding. Ford's Lightning used nearly 150 grams per vehicle for high-voltage systems and sensors. This consumption was growing exponentially as production scaled to meet federal mandates. This industrial consumption was invisible to retail markets until it overwhelmed the supply chain's ability to serve both sectors simultaneously. The refineries found themselves allocating an increasing percentage of their production to industrial contracts at premium prices, leaving less material available for the wholesale distributors who supplied retail dealers. The dealers, unaware of how severely their supply chain was being constrained, continued accepting orders from retail customers until the moment their wholesalers could no longer deliver. The breaking point came when several major industrial users simultaneously accelerated their purchasing programs in response to intelligence about potential supply disruptions. Apple quietly doubled their silver procurement targets for Q1 2026 after their supply chain analysis indicated that component shortages could delay iPhone production. Ford's procurement team received authorization to purchase 6 months of silver inventory in advance, rather than their normal 30-day supply, effectively removing millions of ounces from the available supply pool. These industrial stockpiling decisions created a cascading shortage that rippled through every level of the distribution network within days. The wholesalers who supplied retail dealers found themselves unable to source adequate inventory from refineries that were prioritizing industrial contracts. The dealers who served individual investors discovered that their wholesalers couldn't fulfill orders that had been routine just weeks earlier. By Wednesday morning, the retail distribution system was operating on fumes, with most dealers holding less than 72 hours of inventory while continuing to accept orders from customers who had no idea how precarious the supply situation had become. The first dealer to acknowledge reality and suspend sales triggered a psychological tipping point that forced others to admit they were selling silver they couldn't deliver. The response from remaining dealers revealed just how desperate the supply situation had become. Provident Metals raised premiums by 40% overnight, hoping higher prices would slow demand. Liberty Coin suspended new orders while trying to fulfill their backlog. Golden State Mint converted to pre-order only with 8 to 12-week delivery dates. BGASC limited customers to 100-ounce maximum orders while Money Metals created a two-tier market with premium pricing for immediate delivery. Local coin shops faced severe challenges, many closing temporarily or charging $20 or $25 premiums above spot prices. The pre-order strategy exposed fundamental problems as dealers accepted money for silver they didn't own or couldn't source from wholesalers. They were gambling on finding future inventory at reasonable prices, using customer payments as working capital while their business model collapsed. I realized that the sold-out banners appearing across dealer websites represented more than temporary inventory shortages. They marked the transition from a functioning distribution system to a rationing system where access to physical silver would be determined by factors other than simple market pricing. The dealers were acknowledging that they could no longer guarantee delivery of products they advertised, fundamentally breaking the trust relationship that sustained retail precious metals commerce. The psychological impact on investors was immediate and profound, as they discovered that wealth stored in digital accounts or paper investments couldn't be quickly converted into physical silver regardless of their willingness to pay market prices. Forums and social media platforms erupted with frustrated posts from people who had waited years for silver prices to reach these levels, only to discover that the metal had become effectively unavailable to individual buyers. "I've been watching silver for 5 years, waiting for it to break above $60, posted one investor on Reddit's Wall Street Silver Forum. "Finally happens and I can't buy a single ounce anywhere. Called 15 dealers, checked every website. Everything's either sold out or on 3-month delay. How is this possible when the price is only $62? The question captured the surreal nature of a market where rising prices, which should theoretically bring supply and demand into equilibrium, had instead revealed that supply was insufficient to meet demand at any price the retail market could afford to pay. The dealers weren't refusing to sell because they wanted higher prices. They were refusing to sell because they had no silver to offer, regardless of what customers were willing to pay. The industrial demand that was draining supplies operated according to entirely different economic logic than retail investment demand. When Samsung needed silver for battery production, they viewed it as a strategic input with value far beyond its spot price. Stopping a billion-dollar manufacturing line for lack of silver would cost more than paying $80 or $90 per ounce, so they were willing to bid whatever was necessary to guarantee supply continuity. Retail investors, operating with limited budgets and investment timelines, couldn't compete with industrial users who treated silver as an essential production input rather than a speculative investment. The dealers found themselves caught between customer segments with fundamentally incompatible economic priorities, unable to serve retail customers when all available silver was being absorbed by industrial buyers at premium prices. The shortage was compounding itself through hoarding behavior that accelerated as news of dealer closures spread through precious metals communities. Investors who had been considering gradual accumulation suddenly attempted to make large purchases before availability disappeared completely. Dealers who still had inventory reported order volumes 10 to 15 times their normal levels as customers tried to buy years' worth of silver in single transactions. This panic buying exhausted the remaining inventory at an exponential rate while creating new problems for dealers who were trying to manage their exposure responsibly. Accepting massive orders from customers would require sourcing silver at whatever premium prices their wholesalers demanded, potentially creating losses if they had promised delivery at fixed prices. Many dealers found it safer to suspend sales entirely rather than risk catastrophic financial losses from orders they couldn't fulfill profitably. The international arbitrage that normally helped balance regional supply and demand imbalances was working in reverse, draining Western silver stockpiles to feed Asian industrial demand that operated around the clock regardless of weekend trading halts or market closures. Chinese electronics manufacturers and Korean semiconductor producers continued consuming silver, while American dealers were frozen out of markets that had adequate supply but demanded prices that retail customers couldn't afford. The silver that remained available to retail markets carried premiums that made investment purchases economically prohibitive for all but the most determined buyers. The few dealers still accepting orders were quoting prices $15, $20 above spot for standard products, premiums that historically appeared only during extreme market stress or temporary supply disruptions that lasted days rather than weeks. These premium levels effectively priced out the middle-class investors who formed the core of retail precious metals demand, leaving the market accessible only to wealthy collectors and institutions that could absorb the additional costs without material impact on their investment returns. Silver was transitioning from a democratically accessible store of value into a luxury item available only to customers with substantial discretionary capital. The government response to the retail supply crisis revealed how little policymakers understood about the relationship between industrial demand and investment availability, with officials applying outdated regulatory frameworks to a commodity market experiencing unprecedented transformation. Treasury officials issued carefully worded statements about monitoring market conditions for signs of manipulation or artificial scarcity, apparently assuming that dealer closures resulted from speculative activity or market manipulation rather than genuine supply constraints driven by industrial consumption that had overwhelmed production capacity. The Federal Trade Commission announced comprehensive investigations into precious metals dealers to ensure they weren't engaging in deceptive practices by accepting money for products they couldn't deliver within advertised timeframes. The investigators were applying consumer protection frameworks designed for normal retail commerce to a commodity market experiencing unprecedented supply stress, missing the fact that most reputable dealers were suspending sales specifically to avoid such situations, rather than continuing to accept orders they couldn't fulfill. Securities and Exchange Commission officials began examining whether online precious metals retailers were properly disclosing inventory risks and delivery timelines to customers, apparently unaware that the dealers themselves often didn't know when their wholesalers might be able to source adequate supplies. The regulatory response focused on disclosure and transparency issues rather than addressing the underlying supply and demand imbalances that were creating the crisis. Congress held emergency hearings featuring testimony from academic economists who recommended strategic stockpiling programs, domestic mining incentives, and rare earth elements legislation that might help long-term supply development, but offered no solutions for investors who needed to purchase silver immediately. The politicians seemed confused by the concept that rising prices could coincide with reduced availability, expecting market mechanisms to automatically increase supply when demand exceeded available inventory. Senator Elizabeth Warren called for investigations into precious metals hoarding by wealthy investors and institutions, missing the fact that industrial users were consuming silver faster than mines could produce it regardless of speculative activity. Her staff had apparently confused financial speculation with industrial consumption, assuming that investment demand was artificially inflating prices rather than recognizing that manufacturing requirements were creating genuine scarcity. I realized that the physical silver market was experiencing a phased transition from a liquid commodity market to an allocation-based system where access would be determined by factors other than price and timing. The dealers who remained operational were essentially rationing their limited supplies among customers based on order size, customer history, and payment terms, rather than simple first-come, first-served availability. This transformation represented a fundamental shift in how precious metals would be acquired and held by individual investors, moving from an on-demand purchase model to a planning-based acquisition model that required advanced preparation and strategic thinking. The casual silver buyer who could once visit a dealer website and receive delivery within days was being replaced by committed investors who planned purchases months in advance and accepted uncertain delivery timelines. The breakdown of retail distribution was accelerating the transition toward direct relationships between serious investors and upstream suppliers, bypassing the traditional dealer network entirely. Wealthy individuals were contacting refineries directly, offering to purchase entire production runs in exchange for guaranteed allocation. Investment groups were forming buying cooperatives that could purchase silver at wholesale quantities, sharing the costs and logistics of larger transactions. As I compiled my analysis on Saturday, December 13th, the scale of the transformation became clear. What had started as isolated inventory shortages had evolved into a systematic failure of the retail precious metals distribution network that would reshape how individual investors accessed physical silver for years to come. The dealers hadn't just temporarily run out of inventory, they had discovered that their entire business model was incompatible with the new reality of industrial silver demand. The physical silver supply is gone wasn't hyperbole or marketing exaggeration. It was an accurate description of the retail market's inability to source silver at prices that individual investors could afford to pay. The silver existed, but it was flowing directly from refineries to industrial users at prices and in quantities that excluded retail participation. The dealers who froze sales were acknowledging a truth that the paper markets hadn't yet recognized. Physical silver had become a strategic industrial material that happened to trade on financial exchanges, rather than an investment commodity that happened to have industrial applications. That fundamental shift changed everything about how silver would be priced, allocated, and accessed in the emerging scarcity economy. Individual investors who owned physical silver before the distribution system collapsed would benefit enormously from the transition, holding assets that had become genuinely scarce and increasingly difficult to acquire. Those who had waited for lower prices or planned to begin accumulating silver gradually discovered that their window of opportunity had closed permanently, replaced by a market structure that favored large-scale, long-term planning over opportunistic purchasing decisions. The frozen dealer websites weren't temporary inconveniences. They were tombstones marking the end of an era when precious metals could be acquired on demand by anyone with sufficient cash and internet access. The physical silver supply hadn't disappeared from Earth, but it had disappeared from the reach of ordinary investors who could no longer compete with industrial users operating under different economic constraints and priorities. What emerged from this distribution crisis would be a fundamentally different market structure, one where access to physical silver required advanced planning, premium prices, and acceptance of uncertain delivery timelines. The age of casual silver accumulation was ending, replaced by a scarcity-based system that would separate committed investors from opportunistic speculators through price and availability barriers that couldn't be overcome through determination alone.